A clear implementation of the NDP can bring back investor confidence into the local economy. It argues that this is particularly pressing as South Africa needs capital inflows to finance the growing current account deficit. Old Mutual says prospects for increased exports look weak, while a softer rand has so far failed to contain imports.
The deficit, of course, is partly consumer driven, but it's to a large extent driven by capital inflows related, by capital goods imports related to the infrastructure program. So it's a kind of a good import because it increases the capacity of the economy. But in the shorter term, you still need to finance it. So our biggest challenge in the short term is to finance the current account deficit, which sits at currently about $20 billion a year. That's a big inflow that you need to finance the deficit.
On the global front, the investment group sees an acceleration in growth from around 3% currently. It says the effects of the global financial crisis and the European economic crisis continue to fade away. This is positive for equity markets, which have continued to outperform other investment classes.
I'd say there's a good chance of a double-digit type return, total return, including dividends in equity market, and only a single-digit return in cash and bonds.
And with China's slower economic growth, no significant strength is expected in commodity prices. This is not particularly good news for local mining companies, which are already battling rising costs and an unstable labor market. Liuta Mutlogelwa, SABC News, Johannesburg.